All right, today we're diving deep into a really common and kind of tricky issue for anyone dealing with international investments. We're talking about how you prove a foreign tax credit when the one piece of paper the IRS loves, the Form 1099, is completely missing in action. So let's get right into it. So this is the situation, right? Your client paid real foreign taxes on a real dividend they received. But because the company or the brokerage is foreign, you never get that nice, neat Form 1099 DIV. You know, the one that makes the IRS's automated systems happy. And just like that, the entire burden of proof shifts completely onto your shoulders. And that's why we're calling this the Ghost Dividend. The money is real, the tax paid is real, but from a U.S. reporting perspective, poof. It's invisible. It's floating in this reporting vacuum, and that vacuum is exactly what creates this compliance tightrope that we have to learn to walk. So here's our game plan for walking that tightrope. First, we'll break down the problem itself. Then, we're going to talk about a really common trap you've got to avoid. After that, we'll dig into the legal stuff, how to actually prove your claim, before getting into the nitty-gritty of the calculations. And finally, the bigger risks you need to be aware of. Okay, so let's start with the root of the problem. You have to remember, the IRS runs on this massive automated information matching system. The payer sends a 1099 to the taxpayer and a copy to the IRS. The IRS computers then just look for that income on the return. Easy. But a ghost dividend completely breaks this process because no third-party report ever gets sent to the IRS in the first place. So where does this little ghost usually pop up? Well, it's typically in one of three places. First, you've got direct holdings in a foreign company. Think owning shares of Siemens or Nestle directly. Second, and this is a huge one, accounts held at foreign banks or brokerages like UBS or HSBC. And third, you see it with expats who get foreign stock as part of their pay. In every single one of these scenarios, the IRS gets zero heads up about the dividend or the tax that was paid. Now, this brings us to a really, really critical point that a lot of people get wrong, the de minimis election. You've probably heard it. If the foreign tax is small, under $300 or $600 for a joint return, you can just stick it on Schedule 3 and skip filing Form 1116. Well, when it comes to ghost dividends, that shortcut, it isn't a shortcut, it's a compliance trap. And let's get technical for a second, because the law is incredibly specific on this. Internal Revenue Code Section 904J lays out 4 conditions, and you have to meet all of them. The income's got to be passive, okay. The tax has to be below the threshold, yep. And the taxpayer has to elect to do it. That it's condition number 2, that's the killer. So what on earth is a Qualified Payee Statement? The regulations are crystal clear. They're talking about the standard IRS forms we know and love. Your 1099s and your K1s. That detailed statement from a Swiss bank? Or a fancy tax voucher from a French corporation? Nope. That's just a foreign commercial document. It is not a qualified payee statement that the IRS system is built to recognize. And that's the whole ballgame. So, here's the absolute bottom line for this section. Because your proof for a ghost dividend fails that second test, the whole de minimis shortcut is off the table. Period. The only truly compliant way to claim that credit, I don't care if it's for $10, is to file Form 1116. Okay, so we've established that we have to file Form 1116. The next logical question is, how do we prove our numbers if we get asked? This is all governed by IRC Section 905B and its sidekick, Treasury Regulation 1.9052. Let's look at how the law ranks the evidence you have. So the regulation creates this 2-tiered system for proof. Primary evidence is the gold standard, an actual receipt from the foreign government's treasury or a copy of a foreign tax return. But let's be real, for a regular investor, that's just not going to happen. And that's exactly why they created the second tier for secondary evidence. And guess what falls in that category? The exact documents we have, dividend statements and brokerage records. Now, the magic words from the regulation are right here on the screen. Impossible to furnish. For a portfolio investor, the IRS generally accepts that it is, for all practical purposes, impossible to get a direct tax receipt from, say, the German Treasury for a dividend withholding. The rules acknowledge this reality. And this specific language is what gives us the legal authority to use our brokerage statements as solid proof. All right, so we've got our legal foundation set. Now let's switch gears and get into the practical side of things. How do we actually reconstruct this transaction to get the right numbers onto Form 1116? Since there's no 1099 to just hand you the gross income number, we have to build it ourselves. This is what we call the gross up. It's actually pretty simple. You start with the net cash that actually hit the bank account. Then you find the withholding tax rate on the foreign statement, and then you just plug those into the formula. Gross dividend equals the net deposit divided by 1 minus the tax rate. That gross number is the correct amount of income to report. Of course, there's another fun wrinkle, currency. We have to translate everything into US dollars, and IRC Section 986 tells us exactly how. For a cash basis taxpayer, it's pretty straightforward. You translate the dividend income using the spot exchange rate on the day the dividend was received. And you do the exact same thing for the foreign tax paid. Translate it using the spot rate on the day it was paid, which is usually the same day. Okay, we've done the hard work. We have our gross income and we have our foreign tax paid, both neatly converted into US dollars. Now it's time to put it all on Form 1116. And trust me, you want to be precise here. This is not the place for sloppy work.
So in Form 1116, there are 3 things to lock in. First, in Part 1, the income basket is pretty much always going to be passive category income. Second, you absolutely must report this stuff country by country. You can't use those shortcut codes like RAC that you might use for a mutual fund. It's got to be FR for France, JP for Japan, you get the idea. And third, for the date paid in Part 2, if you have a bunch of different dividend dates from one country, it's generally an acceptable practice for e-filing to just use December 31st of the tax year.
Now, correctly reporting this ghost dividend and getting that tax credit is a fantastic piece of compliance work. But it doesn't happen in a bubble. It's directly tied to your client's entire international compliance picture. The second you see a foreign account that pays one of these ghost dividends, your brain should immediately start thinking about FBAR and FATCA. Remember, the FBAR, that's FinCEN Form 114, is required if the total of all foreign accounts tops $10,000. And Form 8938 for FATCA kicks in at much higher asset thresholds. And this, right here, is the ultimate tightrope. The very Form 1116 that you file to correctly claim a $500 tax credit, that becomes the thread that an IRS examiner can pull on. And if they pull that thread, they might just unravel a much bigger problem, like an unfiled FBAR or Form 8938, which, as you know, carry penalties that are way, way scarier. Getting this right is about so much more than just one credit. So let's wrap this up with a clear action plan. 1. Hunt down any foreign deposits that don't have a 1099. 2. Do the gross up calculation. 3, and this is important, double-check that withholding rate against the U.S. tax treaty to make sure it's even a creditable tax. 4. Translate everything using the right spot rates. 5. File a clean, precise Form 1116, broken out by country. And 6. Save everything. Archive all those foreign statements in your calculations. That's your proof. If you follow these steps, you can confidently bring that ghost dividend out of the shadows and claim the credit that your client is rightfully owed. But it always leaves one last, critical question that you have to ask for every single client with this issue. You've successfully reported the dividend, but have you properly reported the account it came from?